Deb Kierstead here from Live Skills Money. Today I'm sitting down and having a talk with Keith Tinson, who is a local mortgage broker. I wanted to find out how prepared our kids are right now when they're growing up and starting to buy their own houses. Keith, I have a few questions for you.
Sure.
How prepared are young adults today when it comes to saving for a down payment?
I would say not very prepared at all. It is rare. I've been in the industry for over 20 years. It is rare to see young adults, if we say 20 to 30s, have any sort of significant savings for down payment. And by that I mean not even enough for the minimum 5% down. A lot of that's coming from mom and dad or grandparent or family gift. And on that note, a lot of times it's coming from a home equity line of credit from a parent. So it's not coming from liquid savings, whether they don't have it or what have you, but it is coming from the equity, I'll just say, like, of another home, right? And that's not always been the case. There are, gifted funds have always been something or a portion of it, but more so I would say it's heavily weighted in a gift now for young people who are buying. Whereas it maybe used to be a top up or maybe, even 50% of it. Nowadays, you're seeing next to no savings, and a parent, helping them get into the market, because that's the good thing to do. And that's a very good point. But without that parent who had obviously money managing skills, they wouldn't be able to do that.
Right. So essentially the parents are buying the house for the kids.
Well, essentially, yeah. And then, the parents are, the kid can afford the payments or what have you, but they have no, I don't know if I could say that they don't have an appreciation, because it's been just another thing that maybe is handed to them, if you look at it that way, because, saving for a period of time to get a house, or at least have some skin in that game, really makes you appreciate, what you're buying, right? And when a parent comes along, and not the fault, parents are nice and that's great, and gives you the gift, and that's a great thing, and then you get into the house, I don't think you really appreciate what's gone on. And it might be a good move to be in the market and get a house that's earning equity as you pay it down. But I think the mindset still isn't there, compared to actually planning to achieve that goal. Because now you just have this thing, and now I don't think spending ever changes besides, paying your bills and things like that with the house. But from a savings standpoint, it's not uncommon to see people who have had a house for a long time have no savings pattern as well.
Right. What common mistakes do first-time buyers make with money before applying for a mortgage?
Car loans, big car loans. It is not uncommon to see car loans over $1,000. So I work on multiple files a day, close to 100 throughout the year. Car loans they're basically like silver bullets when it comes to an application. It is not uncommon, like I say, to have a truck loan. Trucks are big. I think the F-150 is the number one selling vehicle in North America, definitely in Binbrook, where I live and you add gas and things like that on there, not only just the loan from a qualifying standpoint, but you can understand why they don't have enough disposable income to save, right? If you put insurance of, let's just say $200, they're young, car loan of $1,000 plus gas of say $400, you're up close to $2,000, and that's eating away, and that's before having fun. So when it comes down to miscellaneous expenses, if we did a budget, oftentimes they're overweighted there, meaning they're spending more money on fun, and it drops out first as savings. So that's why in the first answer they don't have it, right?
Right.
Yeah.
How often do young clients come to you without a clear budget or saving plan?
Well, I would say, I might sound cynical, but I would say all the time. And I would say the reason, I would say it's not just young people, but to that point, it's never started, right? Like they don't have a savings pattern. They're living paycheck to paycheck, as the old adage says, but the reality is they are, and they're not saving any money. Savings, instead of coming first, comes as the last thing, and usually on a list, things like that don't get accomplished. So even in situations where there has been some savings, it's usually been something that's been forced or guided by a parent. So an RSP is one. Your typical young person doesn't go out and get an RSP. It's something that's been instilled with them from a parent, which is a great thing. But additional savings on the side is rare to see. Not to say it doesn't happen. It definitely does happen. But it is it is something that is noticed rather than what the rule is,
Right.
I would say.
What's the most surprising thing you've seen a young client do with their money when preparing to buy a home?
Well, on a positive note, I would say having a significant amount of savings. It's very rare to have a full down payment, 20% on where the prices are now in Ontario. Is very rare. It's an admirable thing that someone's been able to do that. But someone who has an established savings plan, whether it's an RSP, a first time home buyer, a government savings plan, a TFSA, or something along those lines, let's say a more sophisticated savings plan, that's a surprising thing to see that come across. If I ask someone, okay, down payment, I'll usually ask this question. And for your down payment, where is it coming from? Is it coming from savings, a gift, or a combination? I most, if not always, assume there's a gift going to be involved. It's rare that someone has a fully sophisticated savings plan and is able to pull from there. Now, again, there are people that have that, but that is definitely not the norm.
And not to toot my own horn, but my son was one of the recent people who did have the 20% down because he had a savings plan.
Oh,
right?
absolutely. Yeah, absolutely. And to bring that up, which is like, I mean, that's the guy I thought about, right? And, it is a difference maker. And I said that prior to being asked to have this interview, you just don't see it. And you don't see it in older folks either. Like, you just don't see it. You see it in a generation that's maybe removed, past, even the baby boomers aren't the best at it. But that generation that's older than that are, now leaving the earth, right? But it's super rare to see that. And, what goes along with that is a sense of responsibility is, I had mentioned that, good guy to talk to, seems like an adult. Do you know what I mean?
Yeah.
Whereas adults nowadays don't seem like adults that much. They're kind of just, there's no saving for a rainy day, and, that's where refinances come from, which I'm not complaining. It's part of the business. It's great, but it's because of established savings plan. There is no behavioral change in people at a small age where they just want to spend all their money. They either don't care and it's come by way of, they've just collected money and they don't really care about buying things, or you see people who are constantly spending, right?
How do poor money habits affect a young person's ability to qualify for a mortgage?
Well, it's probably multifactorial there. The initial thing would be credit rating. So credit rating is sort of who even knows how to figure that out? Even Equifax or TransUnion won't tell you the exact method that your credit is impacted. But if you don't manage your money well and you still are buying things, you're likely using credit. So credit balances, although they might not be late, might make your payments all the time. We hear that all the time. I make my payments on time. Well, sure, but your balance doesn't go anywhere. That impacts your credit rating. Multiple cards, lines of credit, and then it comes down to actually late payments on that type of credit. That impacts your credit as well, your credit rating. So right there is one area that I see it. But then if that's present, it's also indicative they likely don't have savings, right? Because they're spending more than what's coming in. And in this part of the world, it's very easy to want to consume everything. We all know we can order things late at night that we don't need, and that all adds up. Gas, food, everything's more expensive now. So a kid that doesn't have actual set spending habits or saving habits is in a difficult spot to exist in this world. And if they don't have, well, no, I can't do that on the weekend, or I can't do this, or have a goal in mind, they often end up with credit balances. They often end up with impacted credit. It doesn't even have to be bad, but they could suffer from something called slow repayment. And that's a note when they're buying a new house. If they don't have spotless credit, or if they don't have decent credit, a lender might say, well, what's with the slow repayment? And if they're on the edge of being approved or not, that could go the other way for them. It doesn't always, but that could go the other way. So I would say that money management in general, they just don't value a dollar, and they don't care about how it impacts them down the road.
Right. Yeah. Are there any financial behaviors you notice that separate the successful young buyers from those who struggle?
Well, from a savings habit standpoint, people who have an automatic savings plan, so, they get paid, let's say on a Thursday, and, their obligations for the month, including savings. So obligations are any sort of debt payment, rent, whatever it is, we all have utilities and things like that. Even if they're living at home, cell phone, car insurance, things like that. If they have a plan in place that distributes that money immediately when it comes in, including an automatic savings plan, whether it's a contribution to a RSP, whether it's contribution to TFSA or just a regular savings, when someone has that in place, you see that person has managed everything else well. They don't carry balances on their credit card, or if they do, it's not the norm, right? They budget to buy things, like they plan things. Not I'm going to buy a new car. I need this car right now. They plan, well, in 6 months, so I'm going to do this, or I plan on doing this. The other thing too is, more often than not, someone who has a savings plan for a home doesn't want the highest ticket house. They want something within their means, that they're not going to be fully house poor, meaning the cost of running the house leaves them very little to save again. They want to stay in the lifestyle that they have while taking on the new costs. So they realize there's going to be some change, but they still want to save, or they don't want to use all their savings, right? Because they want to use that for, let the dust settle, a rainy day. They still have that safety net idea. So I would say overall, they're responsible money managers. They understand what money is, what it takes to earn that money, what it takes to save, and what that money can buy. It doesn't become frivolous, right? Like, they don't just throw caution to the wind. Oftentimes people who don't have those skills, and maybe they're getting a gift from mom and dad or whatever, I usually do a maximum pre-approval. I say, and just so you know, you can go up to here, and then, work within that. So as you're shopping, it's an easy tool. They always want the top or push envelope. I say always, but maybe not, but it's the reality, right?
Yeah.
Also, the other thing too, even though I'm a bit long-winded with this, is everyone wants the newest thing. So they want the new appliances. They want everything brand new. So money doesn't mean anything to them when it's on credit, because they don't have any savings. So it's not their money. So mom and dad might give them a gift for a down payment, and then the rest is on them, and that will likely go to credit, because again, they don't have anywhere to draw from. Someone who has a responsible plan and put it in place, has budgeted for things, and doesn't necessarily want to take on new debt. They might do it, but their plan is to pay that off as soon as possible. So
thank you.
You're welcome.
How important would you say is it for young people and teens to learn about budgeting and saving if they want to buy a home in the future?
Oh, I think it's invaluable. It's not taught in schools at all. I used to do something where I'd go into schools, and I don't remember exactly what the course was, but it's not taught. It's not taught in math. It really should be taught in math. I was talking to my son about it, and he's in grade 9, and he's like, yeah, that makes sense. It should be taught in schools because it's so easy, because it's applicable. How often do we hear, why does math matter? I'm never going to use this. In reality, you're probably not, unless you're an engineer or that, but when you're dealing with money every single day for, your groceries, your well-being basically, or the things that you want, or trips, or whatever it is, whatever your heart's content, when you're not learning any of that as a teenager or even younger, it doesn't sink in, and it's not important, right? So I think that, to answer your question, hopefully answer your question, I think that if they were to teach it in schools, it would be just an incredible change to how people manage their money. Now, it's not going to be full scale across the board, but your average teenager is not going out to find a way to save money. They're just not.
Yeah.
Your parent, busy, distracted, whatever the challenges are, probably don't have the skills themselves. And if they do, they have to make effort to teach their kids. It's hard. You're not a teacher. So that becomes difficult, right? So that's why I think so many fall through it's not even a crack, it's a chasm. So many fall through to be in the spot where they are. And then when you look at Canada's indebtedness, everyone likes to point to the States, but we often exceed theirs. We are indebted because of poor money management. I can argue that there's so many things to buy, but if a kid doesn't know growing up, he's not all of a sudden going to become an adult that understands this. Just like any rule we teach your kid, with respect, please, and thank you. If you never press it in, and then when they're 25, they just start doing it, well, that's just not how things work. They're actually going to be ignorant as they move forward. And that's what we are. We're kept in ignorance, unfortunately, by the system. And kids need to learn how to manage their money.
Well, they say that money habits start to lock in at age 7. So,
Really?
yeah, if you're, waiting till you're 25 to start learning how to manage your money, well, your habits are there, right? And obviously you can change them, but it's tough. And
Oh
I
yeah.
mean, I always like to say, okay, yeah, we learned the Pythagorean theorem, the quadratic equation. How many people use those? But money, like literally everybody will use money. Like there's very few humans in this whole planet that don't use money, right? And literally
100%.
every day of your life. So probably we should be teaching it in schools.
100%, because those theories I've heard of the one. I don't remember it. I don't remember half the stuff you learn in school. And sure, it's about learning and all that kind of stuff, but why not, and being disciplined and all that kind of stuff, but why not throw money in there and hit it on both ends? It makes
it's a
sense.
yes and, right? No one's saying to stop teaching those, but we should be teaching the other as well.
100%, yeah.
Yeah. What's one simple habit you wish more young people started before adulthood related to your job? Like what's something?
Well, I think understanding that savings doesn't have to be like a negative or a lame thing. Oh man, it's I think looking at, say, a pay stub, like even if you're cutting lawns, you're getting $20. I don't know what the going rate is now. My grandma gave me $20, so I think I was overpaid. But I'd cut the lawn, and that $20 is really, let's just, as an example, it's really $15, right? Because I'm going to take a quarter, I guess, right? And I'm going to put that into savings, whether it's a shoebox, whether it's mom and dad, whether it's a savings account. I think expecting that the full amount you get is not the full amount that you have to spend, and understanding that and accepting that early on is a great way to set yourself up for further money management when things become more expensive and there's more variables involved. But also allows you to control what you want to do with things. Having savings to be able to action anything you want to do, whether it's buying a house, whether it's buying a car, whether it's making repairs on cars. Like you can go on a continuum from great fun stuff to emergency stuff, but having that removes so much stress that you don't have to think it through. There's enough decisions to be made. If you just put that simple habit in place, like brushing your teeth or locking the door when you leave the house, you just teach it, those kids are set up for life, and they'll make the decision. They might make bad decisions. They might get in a situation where, money's compromised, whether it's investing or what have you, more sophisticated ideas, but they're going to have the money to make the decision. They want to make a bad decision, exactly. But they are going to have the money to do it, right? So I think that would be the best way. What was the question exactly? It was best.
What simple habits?
So, yeah, it is a simple habit, and that's why I asked you for that specific word. It is simple. It is relatively simple compared to any other thing you have to learn in your life. You just have to not spend it. You just have to take a step back and realize it's not a need, it's a want, and you can probably accomplish it buying it down the road. You just gotta pump the brakes, right? And be systematic about it. I think that would be a huge game changer.
And you just adjust, right? You just adjust to being used to living off of that amount of money.
Yeah.
And things happen, right? Like my younger son, who's 19, just wrecked his car. So he had to buy a new to him car. Well, he had the savings to do it. He wasn't happy about it, but, it wasn't, I'm not going to have a car now, right? And it wasn't mommy and daddy bailing him out. He's buying his own car.
Yeah, it wasn't a phone call that just goes silent after I just wrecked my car and it's going to cost this much. Hello, you still there? Yeah. So, and that's wonderful. It's wonderful to hear. Yeah.
So how do credit scores impact a young person's first mortgage, and what mistakes do they often make?
Yeah, so credit scores can really have a negative impact, because I always say you can destroy your credit like that. Building it back takes a long time. So if you are someone who has multiple credit facilities, they're called, so credit cards, lines of credit, is typically credit cards with younger people, because they're, you want to get a Montreal Canadiens shirt, so you get a credit card they give you. I mean, that's what happened with me. And then you think you got all this credit, or you got all this money available to you. You're going to go to Foot Locker and buy a bunch of things. That's what I did. That's exactly what I did. I treated my brother to shorts. I bought Raptor shorts.
Free money.
Yeah, free money indeed. I really had no concept of it. Now, I'll tell you, I grew up in a home where my mom worked for the bank and things like that, but I wasn't really taught any money management. I watched my parents manage it, but I wasn't actually hands-on taught that. So you can damage your credit. I didn't, but you can damage your credit by going by continuing to go along that route where you can't pay back your credit card bills in any sort of systematic or noticeable or impactful way where the balance is changing, having a high balance, or even if your credit limit is 3,000 and you're close to 3,000, it might not be 20,000, but if it's just sitting there, you will get a lower and lower score. And so if you don't have a score that's 650 or above and you want to buy a house with less than 20% down, you are going to have reduced qualifying ratios, which is hard in this market. If you have it under 680, you with some lenders that comes into play. But if you're in those 600, you might have to wait. And everyone, I got to get into the market. Well, that's another thing that you might not be counting on, right? So the other thing too that is shown with credit is that even if you have a decent score, and maybe one that needs not a decent score, let's just say even if you have a score that requires an exception, if you have the term is established savings pattern, that's what an underwriter will say, or a bank or a lender. They don't trust you to manage money well, meaning they don't trust you with the mortgage they're about to get into a contract with you for 25, 30 years. They say, so far, your credit is impacted, that's that money management, and you have limited savings. So adding this in, even though you might qualify by the standards, how is it that we're comfortable with you managing this? Because it's just a matter of time before you can't pay us. So that happens. Now, our market does give approvals, but there are cutoffs. And if you're buying with less than 20% down, which most people are, when you're young, if you're buying less than 20% down, you are at the beck and call of the CMHC, Sagan, or Canada Guarantee, which are default insurers. They're crown corporations, most part, I believe, and they have hard lines. And if you don't fit, you're not approved. So you add people on to, it just becomes a hairier approach to it, right? So credit's a big deal. And like I said, it can take a long time to build back good credit.
All right. From your perspective, what's the biggest lesson about money you think teens should learn before they leave home?
The risk of sounding like, vague, but like the value of a dollar. Like a dollar is a dollar, a penny's a penny, so to speak. And it might not seem like much, but if you value and respect what a dollar is, you'll value and respect what $100 are. And if you don't, the flip side is you won't value. So you can have endless amounts of money. You look at, countless stars. I was talking with my son about NBA stars. One of his business, I think his business teacher was telling him about, it's not uncommon for in the NBA for guys to be out of the league a few years and be bankrupt because they've been living this life, which is great, go and have fun, but they didn't truly value what they had. Same with lottery winners, right? So lottery winners, I just happened to hear this last week. It's not that they spend all the money and go back to where they were. They actually go bankrupt. So they win money they've never had and they go hog wild, never truly managing it. Now you might say, well, but they were good managers beforehand, but I guarantee those aren't the people who went bankrupt, right? It's the people who were buying lottery tickets, for
As
a reason.
Retirement plan.
That's right. Yeah. And then ended up going wild because they didn't value a dollar. And that sounds like old school, like of some old man saying that. But the reality is, if you don't value it, you will buy endless amounts of little things that add up. And the sum of all parts is that you'll end up living a life that you can't afford. And so it's not the big vacations that people take or the expensive cars that people take. I mean, if you look around, there's tons of people driving expensive brand new cars. Now, I happen to see people, and I know that if not all of those are financed. And the rationale is, well, you can write it off or you can do this, but you're still paying for it. Again, there's not a value of what a dollar is. If you start to value what a dollar is, you will buy a used car. You will buy not the latest, greatest shoes. I know a guy who has over 500 pairs of shoes and doesn't wear, and they're not like 500 pair of, whatever the local brand is at Walmart, like for $30. They're 500 of the most expensive shoes. Now you think about that, but he also has a couple cars, things like that. Not all from a savings plan. Guaranteed. So you can see the excess that's in there when people don't value money, and it happens. And in this part of the world, it's very easy for that to happen. But again, to a long-winded answer, but the number one thing people need to know is the value of money. And in this day and age, especially now in Canada where things cost more, I think what parents can do for teens is that they can explain just how much orange juice costs now, just how much peanut butter costs now. I buy a natural peanut butter that used to be $8.99. Like I'm talking in the last 2 years, it's $12.99 now.
Yeah.
Like I've watched that and I've become a crazy old man who doesn't, but if kids don't understand that the cost of something going up has an impact on you, or the cost of something has an impact, they won't value money. Who cares? I just saw mom and dad do this and they just adjusted. I think making money, you don't have to make money problems. You don't have to hide them, but do you know what I mean? It's not making a negative relationship with money, but a respected one.
Yeah, for sure.
If if I have an allergy to strawberries, I'm not afraid of strawberries, but I respect what strawberries can do to me, right? So if I respect what money can do for me, I treat it differently than if I don't. Right?
Well, thank you very much, Keith.
You're
I
welcome.
really appreciate it.
You're welcome.